Who thought that up? A bureaucrat? Ben Bernanke? Sounds like Paul Sohn, who after watching his videos many times at BWL Vision, my YouTube channel, I think you'll find as I did that maybe he was looking out, but if the choice between worrying about American cronyism, corporate interests preventing financial democracy is fueling the destabilizing force of socialization, and ceasing of pursuit of happiness, means we are giving up all the way back so that Mr. Ben can test his coordinated global quantitative easing macroeconomic growth strategies similar to the models you'll find at the links through my various sites that lead to this spreadsheet, just without any actual idea how to periodically coordinate that, when it will be forced to sell more than $100 billion of bonds in the next month alone to prevent the collapse of our economic system, and a short squeeze in commodity prices that will with little uncertainty put further pressure on the debasement of our currency, which when we notice international investor assumptions we are resorting to when we try to deal with the issue of maintaining credibility despite substantial increases of over 20% in nearly every commodity since May 2010. Hyperinflation is already here. So Mr. Bernanke went to study the monetary changes these capital infusions had effected months after public money was first authorized for short-term use collateralized against artificially rated AAA collateral junk paper certificates from private portfolio of public companies that I referred and aptly publicly described and loosely coined the name a corporate lie loan. You will find many banks had already paid back their short terms, but the short-term issues of preventing a systemic collapse were centered more about the questions of having a virtually implied guarantee from every state in the union obligating us so that state insurance regulators will pay every dollar of liability sold by any insurance agency who successfully sells these contracts for commission to any third party that does not directly benefit the other non-insurably interested entity, with regulations regarding the loan loss reserves that when they go below incurs a net underwriting loss. However, this has been a tenet since the beginning of the United States insurance regulatory agencies in every level of government, from insuring semis, tanks, bulldozers, aeronautical aircraft for private-public use of all kinds during non-combat operational use that was merely a bonus to pay veteran servicemen for their selfless act of needless, unrewarding, unimaginably hellish commitment to pursue civil service under the guise of patriotism.